Hello, this is Dean Kernut, and welcome to the Alpha Exchange, where we explore topics in financial markets associated with managing risk, generating return, and the deployment of capital in the alternative investment industry. For Robert Tipp, Chief Investment Strategist and Head of Global Bonds at PGIM, an appreciation for financial market history matters. And in today's fast-moving environment in which market prices are rapidly adjusting to expectations of Fed policy changes, Robert's perspectives are especially relevant. Our discussion is a review of inflation and monetary policy cycles from many years prior. And through this, Robert shares his insights on the drivers of inflation, calling into question a very basic assumption that nominal interest rates are highly connected to inflation risk premium. Robert points to the importance of demographics and the availability of capital in setting the risk-free rate. Thus, today's longer-dated Treasury yields, well below concurrent inflation, are in part due to the excess of capital looking for a home, hoping to lock in some return over a longer time frame. Through our conversation, we also learn of Robert's views on central bank communication, contrasting the Greenspan era of constructive ambiguity with Powell's focus on transparency. In this context, Robert sees some components of the emphasis on messaging as positive and others, including time-dependent forward guidance, as recently abandoned by Australia, as less effective. Lastly, we consider the implications of higher rate moves on the stability of the ecosystem of asset prices. Here, Robert cautions us that the transition to a higher rate environment may lead to large shifts, micro-flash crashes, and a breakdown in liquidity with respect to the flow that wants to move. I hope you enjoyed this episode of the Alpha Exchange, my conversation with Robert Tipp. My guest today on the Alpha Exchange is Robert Tipp. He is the Chief Investment Strategist and Head of Global Bonds at Prudential Global Investment Management, otherwise known as PGIM. Robert, thanks for being a guest on our podcast today.
Thanks for having me. Good to be here.
I'm excited to have this call. Just as we were about to jump on, you'd said something which I thought was really interesting, which is that market participants tend to underweight the importance of events that happened a long time ago. There's an old saying that history is a foreign country. And so it's maybe the history of risk is another planet. People don't appreciate it. But you've been in the markets for quite some time and have gotten a lot of perspectives. You've seen a lot of cycles along the way. So as we get our conversation started, it'd be great to just learn a little bit more about you and the early formative days of your career. Tell us about how you got started in this industry.
Sure, yeah. So I think that what's really helped me is trying to straighten out my confusion, understand what's going on in the markets, and using the current environment and the questions as a jumping off point. For me, I started off on the structured side. I was at the Wells Fargo Investment Advisors, which eventually became Barclays Global, and then the big passive shop that eventually rolled into BlackRock. I was there for a few years in the mid-'80s and doing portfolio insurance and stock index futures arbitrage and some bond index and enhanced index and bond futures related things. And there are a couple of lessons. One of the lessons that I saw transpire after I left was the interaction of trading strategies and how liquidity could totally dry up in a market. And when you're running a portfolio insurance strategy, you're trying to create a put option strategy, and futures and options markets were fairly nascent then, as was the program trading market in New York Stock Exchange stocks. And so as the market moved, you would need to buy or sell going with the direction of the market. The market's going down, you're selling, market's going up, you're buying. And the stock index futures would trade when futures were at a major dislocation from the level of the underlying stock. So futures became very cheap for an index portfolio. You could sell stocks and buy futures. And if futures became very expensive, you could sell futures and buy stocks, say, for any desk that had the ability to quickly issue commercial paper and do a cash and carry trade. So after, I'd left there in October 87, I think there's a strong element that as the market would go down, people were selling futures for portfolio insurance strategies, which would create an arbitrage opportunity, and a dealer would go in and buy the futures and sell the stocks. and the dot system was not, for program trading, stocks was not really braced for that. And the specialists were backing up their bids on the cash stocks. And you got a kind of a self-fueling vicious cycle there. And all you needed was, somebody else to come in with an independent program trade to kick off the October 87 crash in the stock market, which is, in excess of 20%, if I'm not mistaken, on one day. Since then, and there was a lot of concern after the stock market went down that it was going to take down the economy. But that was not the case. The economy did well. The Fed was early in a hiking cycle at that point when that correction occurred. And obviously the Fed did its best to really juice the system. But they went back and they hiked interest rates a lot, a few hundred basis points. The economy obviously was doing very well. And that was, an example of one, market liquidity can dry up and you can get a spectacular move. That is two, so market liquidity, it can be very ephemeral. And the other, that a lot of these crises are gigantic moves in the market, like 87, like long-term capital, or like the volatility explosion in 2018, were really driven by non-economic phenomena of the market's own creation in some sense. And those are some of the biggest moves. So, you come at this, you think everything's going to make sense relative to the economy and, so on. And then you see all of that get completely swamped, by market technical factors. So those are a couple of the lessons, learned going on there. But there was one other, and I'm a little reticent to go on and on, but it was very striking that in the mid-'80s, we were beginning to come up with the rationales for, which seemed very obvious, for extending duration on the pension side, that pension funds were by and large defined benefit, but everyone was very reluctant to extend durations, even though FASB 87 was coming. And pension accounting was going to run right through the balance sheet. The benchmark for pension funds for fixed income probably shouldn't be the government corporate index, which was kind of the index of the day, or the aggregate, or the Solomon Big broad investment grade, which is, coming in, that's what they're called at that time, right? That really a much longer duration benchmark would be appropriate. And Marty Leibowitz, Salomon Brothers did a lot of very compelling papers, but nobody wanted to do it. Nobody wanted to stick out and do that and be alone because rates were too low. They'd come down a lot from 1980. And, that was very informative of a trend that really has continued almost to this day. People kind of fighting a market trend and then finding out that these things can go on for a very long period of time.
It's fascinating that you bring those three big volatility events into the conversation, 87, 98, and this VIX event of early 2018. And I think it's spot on that these are really financial events. They're in some ways about price agnostic buying behavior or selling behavior, depending on which way you're going. And one of the things about 87 I'd love to get your take on is if you go back to the period leading into October 19th of 87, what you'll see there is Treasury yields getting higher and higher and higher. I think the 10-year in the week or so before the 87 crash got to on the order of 10.5% nominal. And inflation was rising, but it was, call it 4.5%. So this gigantic real yield. And to me, if you step back and you sort of think about the switching costs, I could get out of this increasingly volatile and tenuous equity market, and I could get into this government-backed security that's got a nominal yield of 10.5% and even a real yield of 6%. So that switching cost, I think, might have been part of the scenario. Just curious, when you were looking at the kind of bond market versus the stock market dynamics back then, what did you see?
Yeah, I think, bonds were for sale. People were not convinced because if you looked, at that range, and the Fed funds rate in that cycle went from, 5 7/8 up to 9 3/4 by 1989 with that little break for the stock market crash. Everything that you'd seen going back to 1980, for the most part, was in between 8 and 20%. I think there was a 16 1/4 coupon issued probably right around 1981, but definitely 14s issued in 1981. So the market's selling off, the 10-year going from a 7% area to a 10% area, it was a steep sell-off, but it was not clear to anybody that this was a buy. And in fact, that's what I was seeing is that, people felt like you really needed to have a big, fat real yield, not 5%, but something much higher in order to make bonds attractive. And of course, those 10% yields, as you're pointing out, they were, never seen again after, the end of the 80s. Yeah, so they seem really high now, but they didn't seem high to people at the time.
I think we'll spend a lot of time talking about the current stance of monetary policy, how the Fed interacts with markets, both through what it says and what it does. But just through your insights here, we have the benefit of learning about some of these other bond market episodes. And again, we were talking about the reality that so many market participants just have not really traded through a real hiking cycle. And so I thought it might just be interesting to get some of your perspectives on the early 90s. And of course, the climax was 1994. Tell us a little bit about the period leading into that 1994 hiking cycle, how it was that folks got caught so off guard on that cycle.
Sure. I think communication has come a long way. And Alan Greenspan had basically a policy of, in fact, even though he referred to it, I think, kind of tongue in cheek, as constructive ambiguity. But he will say, in his, say, autobiography, that if you have more opinions in the market, you will have more liquidity, and that's good. And he was an ardent believer that the market would take care of itself. It would regulate itself. It would function well on its own. And so, there had been a terrible recession in that 89-90 period, and the Fed cut interest rates down to 3%, which was a 0% real yield, which was kind of scandalous at the time. It was being very aggressive. And when it became clear that it was going to be time to hike rates, he didn't really go out of his way to aggressively warn the market. He was a little bit Delphic. So I think that, goes a long way towards explaining that after the market had really left for, astute traders out there, just a softball over home plate for about 3 years running, where they were in a cutting cycle, and yet the forward curve was extremely steep. And so traders were, rolling these $0 call spreads, down the curve and making money. And, when it came time for that to shift, there was not a lot of communication, and then a couple things went wrong. It had been a low volatility rally, and there was a lot of derivative buildup, a lot of structured notes with collars on them, which ultimately were not that badly structured, but the forwards blew out of the range of the forwards, and that created big troubles for the likes of Bankers Trust, and their customers that had been involved in the derivatives, and hedge funds, that had a lot of mortgage exposure on that were not prepared for that kind of extension risk. And so those are a couple examples of half the problem. The other half of the problem was that the Fed, I think, had a vicious cycle relationship with the market. And so when the market pushed up rates eventually, aggressively, to get ahead of the Fed, the Alan Greenspan, Don Cohn combination at the Fed, I believe, thought that the market was signaling they were behind the curve and they needed to do more and they needed to do it faster. And so as the cycle went on, they abandoned the 25s and 50s and 75s. In the course of basically 12 months, they hiked 300 basis points, but ended up, being at the peak of the cycle only from, around, the beginning of February to the end of June. So there are 4 months, at the peak, and then they ended up taking it back. And so I think that was another compounding problem, was them chasing the market, thinking the market was telling them something, when the market, in fact, was trying to get out of the Fed's way.
I always thought Greenspan's purposeful obfuscation was fascinating and interesting. I wanted to get your take on that, right? And I love the way you frame it, that this idea that there are a number of opinions in the market. Clearly, the markets are not as self-correcting as perhaps the textbook might want us to think. And I know Greenspan, post the 2008 collapse, had a kind of a real revisiting of his own thought process there. But just in terms of juxtaposing the philosophy of transparency today, where we're thinking about talking about tapering and trying to give a big heads up to where we're going, versus that more nuanced, hey, you're going to have to figure it out for yourself philosophy. Do you have any strong views on one versus the other? Are there costs and benefits to each view?
Yeah, sure. Well, I think, the fact of the matter is everybody is in the same boat. And the central bankers, I think the transparency has served them well. I think certain kinds of forward guidance have not done so well. And so I think there was this, and they do them for various reasons, but I think the time-dependent forward guidance has proven to be very difficult. And the most recent, casualty kind of seen there, it was Reserve Bank of Australia, where they're very quick to come out and say, hey, we're going to be on hold. We think at zero doing QE for a number of years, and then have to completely reverse on that. And so I think the state-dependent forward guidance is probably a much better way to go, where, we think this is going to take a number of years. So that state-dependent forward guidance is a way that effectively communicates that you have a set of conditions. And, the central bank is then, at one with the market of interpreting the data as it comes in and reacting in a predictable way. And I think given that the economy is not predictable, that's the best you can do, and showing a real open-mindedness. And I think that's a big difference right now between, say, the two most active, biggest, most visible central banks, so that'd be the Fed and the ECB, between the way they're acting now and the way they've acted at some points in time in the past when they have not been effective in their communications and not open-minded in their approach, I think.
If we go back even further than the Greenspan hiking cycle of 94 and go back to Volcker and just think about the speed of those rate hikes, is it that the reality that we just live in a world of such connectedness in terms of risk exposures that the markets have become so big that the central banks, as they contemplate what they should do, that they just have to pay more attention to potential negative market outcomes? Was it easier for someone like Paul Volcker, even though the problem was gigantic, that the markets were just not nearly so financialized?
The Volcker experience is an interesting one. I mean, that whole period was incredibly different than what we have now. And honestly, I've heard some say that economics is not really a science because you don't have any controlled experiments. And so I think there's a tendency to believe that this aggressive central bank tightening cycle of the Volcker Fed was key to bringing down inflation globally. But, I think the markets and the economies actually modulate themselves a lot more than you'd think. And which is to say that I think the inflation in the 70s had a lot more to do with the fact that you had a young demographic that, given the right incentives, would borrow in order to buy more durable goods now for their future. And you had very high tax rates. And investors were highly compensated for making long-term investments that created tax shelters, passive losses, like real estate, income real estate. And, your tax rates came down from 65% in the 80s, but they were 65% and up around the world prior to that. And so there was a lot of motivation to borrow. And there was very high level of unionization and indexation of wages relative to what you have now. And you had the OPEC price hikes. And so, inflation went up everywhere and it came down everywhere, whether you had a Paul Volcker or not. So I'm not convinced. I think in a way, that whole Volcker experience may have created an illusion of control that's not really there. So I think these central banks are incredibly impactful on the markets, and they control, one end of the yield curve, and the economy is forced to come to an equilibrium around whatever rate setting policy they take. But I think they have made some serious assumptions that may be costing us in terms of their highly targeted inflation goals, goal achievement processes, that are contingent on a very high knowledge of exactly where inflation should be. So, it's a very, very different world now. I think it's a lot more like it was in the, 1800s, where you had global markets, you had price stability. One of the things that became clear to me in the 90s and trying to understand what was going on and seeing rates steadily come down from the Volcker period was that the demographics were unique. You'd never seen that kind of a surge in populations with those motivations to push up rates, and that it was much more normal for rates to be, say, below 4% for developed government bond markets. And, a lot of the rationale for that came from looking at markets, the information that was available from the 19th and 18th centuries. So, I think a lot of what's happened over the last 40 years would have happened with a pretty broad range of central banking policies. I'm not sure how much the specifics of their policies have actually driven the long-term rate decline.
I mean, that's an incredibly powerful statement to kind of step back and at least entertain the idea that so much of this, the cause and effect that we, as market participants and certainly as policymakers, they must want to believe in. I'm sure there's some economic logic behind this, but one of the things you mentioned, especially as you talked about the 70s, and in some of your research that's posted on the PGIM website, you talk about the importance of population growth. One of the charts in here is quite striking, just in terms of 10-year average population growth. And, you can overlay that against nominal rates, and that's certainly a pleasing graph to look at. They seem to be related. Tell us just in terms of how much impact and how much import you place in this as a kind of an overriding factor in terms of low inflation and low rates.
Right. And of course, I don't know, but the graph that you're referring to, what we used to refer to as the Mount Fuji of interest rates, that you spent, the post-war period up to 1980, climbing this with rapid working age population growth rates around the world and nominal interest rate markets getting pumped up in terms of levels. They were climbing that mountain. And then ever since then, your working age populations have been decelerating. And now in many places, your South Koreas, China, Western Europe, those working age populations are shrinking at an accelerating rate. So is it the demographics of the durables, or is it that and everything that goes with it? And so I think ultimately what it comes down to is back then your marginal price setter for capital was the lender in the 70s. And they were losing money, and they said, hey, listen, it's predominantly a world of borrowers out there. We can set the price for where we will lend, and they will pay. And the economics were there for them to pay because real estate prices were going up 10% per year, and after-tax cost of borrowing, was only a third of the upfront rate. And having deferred capital gains meant you would pay your taxes someday way down the road with much cheaper dollars. So that's how it was. Now, with the aging demographics, you really have a world where durable goods have leveled off in terms of consumption. I mean, right now we're going through an unusual boom coming out of COVID, and everyone has decided they want more housing space and they want more in terms of cars, and it's at a time when supply is really crimped. But, in the U.S., after the auto market had its rapid growth up into the teens, 15 million units, 16, 17, 18 million units a year, it was a very slow pace of growth. It levels off. And, I think one of the biggest drivers of world growth over the last 20 years, up until a few years ago, was China, where they sold 1 million cars a year in 2000. And they had that steady, inexorable rise in all kinds of durable goods, creation and real estate being put into place where autos went from 1 million a year to 30 million a year, and then they leveled off. So then who is your marginal price setter for capital? So the central bank, yes, they have the front end of the curve and they're going to figure out what to do there. But at that point, once the commodity producers and the durable goods producers have been racing to meet that insatiable growing demand from China and to get enough resources out of the ground and so on, when all of that levels off, your demand for capital really goes down quite a bit. And over time, on the household side, the motivations for borrowing have gone way down. Deductibility of property taxes going away, the amount of mortgage interest that's deductible going away. It's a real statement to borrow as a household to, invest in real assets. And so what you're seeing is really a surfeit of capital out there where people are saying, how is it that real rates could be so low? I think half the problem is that the central banks in their inflation targeting, were targeting inflation rates that were too high. They were not achievable, and they guided the equilibrium for rates down at the front end. And at the back end of the curve, you have a lot more people concerned with locking in an income for the long term rather than catching a 2 or 3% funds rate for a year or two at the peak of the cycle. So I think that whole price setting dynamic for rate has changed. And a lot of the notion that inflation is the dominant price setting variable, I think can pretty quickly be refuted by looking at history, actually.
And that's really interesting. If you're just going back to the textbook, you think about a nominal rate as the sum of some inflation risk premium or expectation and some real rate. And clearly there's a lot more going on that kind of speaks to the disconnect. I mean, if we look at a 10-year at 180 in terms of yield and inflation, you take your pick, 4.5% to 7.5%, depending on what you want to look at or how you want to measure it. When you look at that disconnect, what do you see? Is it the expectation that this cycle of inflation is unique and it's apt to mean revert in large form? What are some of the things that you think go to explaining that disconnect?
Yeah, sure. And I think it's half unique and half not unique. But I think it's worth, just considering that, that core rate of inflation in the U.S. came down to 2% and hit that level at the end of 1999 and has been kind of around that level ever since. And over that time period, we've seen rates go from 6% down to sub 2%. So that's, when I say that the inflation, is not the predominant driver of the level of rates, it's the who is more aggressive, the investor or the borrower. But, the inflation is going to play a role there. And so in terms of inflation, half the problem I think everybody recognizes is that you're having a reopening, that COVID is still raging, but there's a large amount of demand and activity that people are determined, consumption, services, getting services rendered at this high rate, when there just are not enough people to provide the services and to get the goods on the shelves. So that's half of it. But the inflation is incredibly broad. And one of the areas, of course, where we're seeing this is housing. And it seems to be a global phenomenon that people are bidding up the price of shelter. And that tends to be very sticky. And so, if you had 3% inflation on housing, likely to persist for some time, that would be one thing. Okay, it's 40% of inflation, but the Fed and other central banks can see, how big that portion is. And if the rest of the inflation components are very low, then, maybe that's not a problem for them. But it's much higher than that. And it's going to be very hard to get inflation down to target as long as these increases in real estate prices persist and that flows through to rents and so on. So I think there is a sticky element there, and that's going to create a difficult decision-making backdrop, I think, for these central banks as we go through the cycle, 1 to 5 years down the road, if those inflation numbers don't come down.
When we think about inflation, as market participants, we're always wondering what it might do for the reaction function of the central banks. Do they get caught a little far behind? And so then it's a sudden stop, so to speak. The forward guidance that got embedded in expectations might have to get ripped undone, as you noted, the Australian experience. And so there's some elements of that seem to be going on. There are some former Fed policymakers, and I'll put Bill Dudley in that camp, that seems to suggest that this policy is so far disconnected from the inflation and growth facts on the ground that the Fed's normalization pursuits are going to take a long time and they're going to be substantial. He even said that the funds rate could wind up at 3.5%, 4%. And I just found that to be really thought-provoking and certainly something I couldn't imagine. But I'm curious what you think. Is that the sort of outcome that you could envision? How do you guys think about that at PGIM?
Sure. Yeah. I mean, I think there's a range of scenarios that can play out, and we're seeing incredibly strong growth. Up until the ADP number printed, the jobs estimate for January, and they printed a negative number, and we had seen a decelerating trend in the establishment survey of the non-farm payrolls for several months, from 1 million jobs back earlier in 2021 to maybe a complete halt in job growth as we came into 2022. And that looked really daunting and would have given you one situation for the central bank where they probably need to move to the sidelines and say, hey, we're going to wait for the inflation to come down, because clearly you're not going to have the income growth. But instead, what happened is with the jobs report for January, they revised up the history. They took down the numbers in 2021 that were up in the million area, and they pushed up all the recent numbers. So instead, you get a completely flat, for the most part, very strong job profile, in that 400,000 jobs per month, which is way above trend growth. And so if that's what's going on as the Omicron is hitting and, creating some anxiety in people's minds about hiring, this is a really strong economy. And, one of the things, we've all seen is it's very difficult to forecast economic variables. And if the global economy remains very firm with very strong job growth, and it turns out this is not just the end of COVID, that return to work, but it's somehow has unleashed a higher pace of growth, the central banks will end up going to higher highs in rates than what they did in the 2018 cycle, which is it hasn't been a straight shot of every time lower highs and lower lows. The 2000 cycle of 6.5 was higher than the 6% of the Jan 95-ish hike, so there have been some higher highs. So I don't think you can rule that out. Maybe that's a, 25% or 35%, probability scenario, because that's right where we're headed. Persistent, high inflation, very strong growth, could easily put the Fed on track to hike at every meeting, at least 25 basis points a crack. I would say, though, that we have seen a really long period of time, say in the Eurozone, of 1% delivered core inflation, and in the U.S. of inflation being below 2%. And also, pre-COVID, it wasn't raging growth. Growth was kind of lousy. And, it's hard to remember that, in 2019, industrial production in Japan and Europe contracted, and Mario Draghi left them in QE infinity and with a final rate cut on his way out the door, and set them on this course of buying bonds until they got the 2% inflation. So is this really a endogenous, extremely strong, above 2% inflation backdrop in Europe, that strikes me as implausible. Now, having said that, I think the first 50 or 100 basis points of rate hikes in Europe will have a beneficial effect on savers. I think the weak link there is going to be, does it push up the currency? And before it gets to that point, does it push the peripheral credits like Italy and Greece back over the edge, because they are getting hit and they've really jangled the corporate market. So I think the prospects of really high rates coming back in Europe or significant rate hikes at all in Japan strikes me as pretty unlikely, that there'd be anything really substantial going on, there. But in the U.S., it is a significant minority probability, I think, that you could go to that kind of high rate level.
Do you think, and just goes back to Dudley again and some of his writing and his recent interview, we talked a little bit about this idea that the Fed needs to engineer a tightening of financial conditions, which is credit spreads, rates, VIX, and S&P, roughly. That's kind of what's in that index. And my question, Robert, is just around the Fed's, as it either guides the markets or actually does stuff, whether it's on the balance sheet side or on the rate side, and then market prices react. Suppose rates go up, suppose credit spreads widen, vol is higher, stock prices come down. Those are tighter financial conditions. Does that, in your mind, do some of the Fed's work? I've seen some references to that, as the Fed was tightening at one point, financial conditions were loosening, and that was kind of undoing some of the Fed's work. Does it work the other way? Can they get some part of what they're trying to accomplish through the financial aspect of markets?
Yeah, absolutely. I think that, when credit spreads widen and stocks, fall, I think that does give people pause. But I have to say, I really wonder, there are two things that strike me about this episode. The first one is the central banks wanted to get a higher inflation mentality, entrenched in people's minds, a little bit higher natural rate of inflation. And they felt very confident that if it was too high, they could bring it down. So I'm not surprised to see them want to take back some of the stimulus at this point. That makes complete sense. But, is the market maybe doing what it's supposed to do? The average American is really not ready to retire. And your employment levels, while the unemployment rate is very low, that gets impacted by people leaving the workforce and so on. And, maybe these high wages and high prices, on the store shelves are what brings back the supply level, are what brings back the workers, to the levels that they could be. And so it kind of has the feeling that people are so sure, that demand should be brought down to the level of supply. I'm a little bit surprised at that confidence. And I would think if everything we'd heard about central bank confidence in the ability to control inflation as opposed to deflation, that they would not be lining up to tighten extremely aggressively, which I think they are. And I would think, one of the things that the Greenspan said that I think was really a positive thing in the 90s was they, behind the scenes and in public as well, suggested that government finances should be on a sustainable path. And they really, they may be sustainable at these kinds of deficits, but it's not a positive, if you ask me. Deficits are incredibly large, and before they go about an aggressive tightening on the monetary side, I would think a tightening on the fiscal side, some kind of structural engineering to get things under control would be a positive. And I think there was some tacit understanding between the Greenspan Fed and the lawmakers and the administration in the 90s that the Fed was holding off, waiting for that legislation to come through, and it did come through. So I'm surprised, at the aggressiveness that people are pushing for hikes after what we've seen the last 25 years on the inflation side.
One of the points that you make is just around the feedback between the Fed's words, how it's the immediacy and the aggressiveness with which it plans to implement policy and the longer term outcomes. And I think you made the point, I want to say it was June of 21. I could be wrong, but there was that real significant yield curve flattening that occurred. The short end came up in yield quite a bit as a result of this Fed meeting. The long end actually rallied. So things like 5s, 30s just flattened hugely, and folks lost a lot of money on that trade. But it was this very different reaction in terms of the short end versus the longer end of the yield curve. And what I'm hearing from you is just in terms of what the Fed's doing now and what that might imply for the longer term outcomes for holding duration sensitive assets is actually a positive. I thought that'd be interesting to hear you talk more about that.
Well, I think there are two interesting things there. I mean, this is a key area where I think that era of price stability that you saw, in the 1800s, after things settled down after the Napoleonic Wars and in prior periods of price stability. And there was a gold standard going on, but the gold standard was not really binding in those intra-war periods. The curve was on average flat. And so people determined that, hey, rates at the back end should be between, say, 3 and 4%. And then the cash rate could be at 0, 1, 2, or 3, or it could be at 7, 8, 9, or 10. And the business cycle ran through the front end, but you had a rentier culture that was more concerned about locking in their income than about, trying to get the last 01 on money market rates, for a year or two. And so I think you're seeing that come about right now for a couple reasons. The one reason is because I think you do have an imbalance of where there is capital concentration. The biggest companies, their constraining link for making more money and making their investments is not borrowing. The biggest and most successful companies are awash in liquidity. So I don't think they're capital constrained. And then individuals, what you see are typically sellers of stocks and buyers of bonds. And I think, one of the things I expected that didn't happen was I thought as people aged, they would have more bonds in their portfolios. And as it's happened, they have chased that. They've been buying the bonds and selling stocks, but the equity allocations continue to go up because the performance of the stock market has been so strong. But the most economically predominant sector in terms of volume of money flows in corporations on the household side, I believe, is extremely concentrated and is not capital constrained and is not borrowing, is not pushing up the long rate. So I think that's half the reason why we've seen the one-year rate in Europe, in the United States, in Australia soar on expectations for rate hikes, but none of those places have seen the 30-year rate. Right now, none of them are at new cycle highs. They hit their cycle highs a couple months ago in Europe. They hit them back in March, probably in Australia, like the US. And the markets have faith that the central banks, will succeed on the inflation front. And I'm not saying that because the rates are not going up. I'm saying it because break-evens have leveled off. So I think the markets have the faith in these central bankers. And I think that's because the leadership at the ECB and at the Fed are different than how they were 3 years ago, 10 years ago, or, back in the 95, 04 through 06 period. I think they realized that you can break this. And Chairman Powell was there, with that view that, we could have a lot further to go. I don't know what this flat yield curve, means, but that market, indigestion is a signal to them. And I think that's why, you could kind of see the stress, I think, in his press conference that, yes, we all think we need to move steadily away from this accommodative posture, but we are really going to keep an open mind. In other words, if things really change, we're not doing it. And I think on the ECB side, Lagarde saw in the 08 period how policymakers could make mistakes that were incredibly costly for the economy. She was on the finance ministry side, I believe, at that point when, Lehman went under. And, of course, before things really got, as things were kind of melting down in that 08 period, the ECB was one of the last central banks to hike. And I think they hiked again in 2011. So, I think she's, seen how these policymakers and their overconfidence and hiking cycles can be very dangerous. So I think they're going to be very sensitive to overdoing it. And right now, you're getting minor signals on the U.S. side. The markets are concerned about the tightening, but not bad. In Europe, though, the peripherals are kind of melting down. Those spreads are widening out, and so are corporate spreads over there.
You mentioned break-evens. As people in the markets, we value the signaling of market prices. We know that sometimes prices are wrong, and sometimes, and this is how we got our conversation started, we talked about some of the events that really resulted from the trades that lived and breathed in the markets. And a trade that has been in the markets for really the better part of 13 years now is quantitative easing and the government ownership of large blocks of very liquid securities. But in the case of the TIPS market, the Fed owns a lot of that paper as well. When you step back and you look at break-evens and the signals, what's the process of perhaps just being careful to disentangle the price from the impact of the central bank in terms of setting the price?
So the central bank is involved, across the government markets, but the TIPS market also has kind of a dedicated buyer base. And I'm sure some of them know exactly what they're doing, but there is a history of the TIPS market not really doing what you'd think people would think it's supposed to do. And, that is to say that, usually if rates, went from 8 to 6, let's say, half of the decline in rates would be real rates coming down and half of it would be break-evens coming down. And so, what you had in the TIPS market was, okay, yes, inflation was 0.5% lower than you thought or 0.5% higher than you thought it was going to be, but the yield dropped, the real yield, dropped 100 basis points and the bond moves 10 points, right? And so the high correlation with nominal fixed income has been generally the predominant driver of TIPS performance. The thing that was different this cycle is that the inflation numbers, the spike was so spectacular that, these inflation numbers have covered the loss of principal side in these TIPS. So that retail support, I think the notion that, these are going to protect me in an inflationary environment has been supported. And so I think, the TIPS market feels pretty well supported, even though I think, over the long run, it's not likely to be a star performing market. So I think, the first handful of years of the TIPS market, we're going to be following commodity prices and trying to get a read. But as you go out the curve, it's very quickly kind of repricing to faith in the Fed. And, to my comments earlier about inflation and housing, I think, inflation may be a little bit stickier on the high side for the next few years, but that the break-even market, is probably broadly correct in assuming, inflation numbers in the U.S. are going to kind of come back to target over the long run.
Well, you and your team at PGIM are overseeing assets in the trillions. So that's a lot of responsibility in a very challenging market where it's just easy to get things wrong. What are the types of things that are just central to what you worry about? What are the kind of scenarios that keep you up at night?
Yeah, so I think the single, scenario that would be the most jarring is, if and as we go through this year, it turns out that the growth does not ebb and the inflation numbers do not come down. Because one of the things that we've seen in this sell-off and over the last 9 months, and I've mentioned it a few times going through here in our talk, is that the market has faith that they're going to succeed. And the implicit pricing is that the Fed is going to succeed by taking the short-term rate up to 180, let's call it. Or the ECB is going to succeed in stabilizing inflation by taking the short rate up to 60 basis points, from negative 50 to plus 60, bang, and it's over. And it begins to look to the markets like, actually, they do need a 4 to 6% or somewhere between 3 and 6%. Anything significantly above 2 for the Fed funds rate or 1 or higher for the ECB, could be very jarring for the markets and could bring you back to that 2018, kind of indigestion in the markets. And so I think that's probably among the known unknowns. I would put that near the top of the list as potential destabilizers. Because the long-term rates, are so dominant in pricing all assets.
As someone that generally focuses on the volatility aspect of markets and in derivatives, One of the analogies I keep just exploring is just this idea that when the VIX gets very high, there's always a tendency to say, well, that's really high. It tends to mean revert back down, that the energy to keep it at 40 just runs out. And usually the policymakers are trying to make it go back down anyway. But at the same time that it gets to 40, if you look at, let's say, VIX options, the kind of conditional probability of it potentially getting much higher, like 60, gets pretty high. It's just that whole distribution really widens out. And this is where I wanted to just end the conversation and get your take on it. But is the Fed as a risk manager now, not managing inflation from below, but managing it up above, and maybe using this VIX analogy, which is that inflation, the level of inflation and the level of inflation volatility are also generally correlated. It's not like inflation gets to 7% and the boundaries of it really tighten. You tend to get wide prints and so forth. And so where I tend to worry a little bit is that the Fed may have to do some things just from a risk management standpoint that are similar to what a market participant has to do. Buy a way high strike on the VIX that's almost unimaginable, but you have to do it because the uncertainty is there. And I'm just curious, when you think about that aspect of the Fed trying to risk manage this in maybe a higher inflation volatility environment, how does that hit you?
What we've seen over the years, and I'm glad you brought it up, is that for any given disturbance to the economy, any given disturbance to the economic backdrop or to the geopolitical backdrop, you've had a bigger movement in markets. I mean, having a couple 50% drops in the stock market so far this century is probably above average. And the markets, the volatility tends to be bimodal. That you'll have a big trending, low volatility move in the market, and then an explosion of actual measured volatility. And I think a couple takeaways for me is that in a low rate environment, or across all environments, that the variations in growth and the underlying economic variables, it's not clear to me that really comes down. And so as a result, if rates are generally going to have some kind of relationship to nominal growth, even though you're at 1 or 2, you're not going to move. You're still going to see rates move, plus or minus 50, 75, 100 basis points. And so, if you think about bonds as a stock, if you're going from, a 1% earnings yield to a 2% earnings yield, that's a lot different than going from a 10% earnings yield to a 9% earnings yield. The one, gives you a change in price earnings multiple from 9 to 10. The other one gives you a change in price earnings multiple, from 50 to 100 or vice versa. And so at these low rate levels, you are seeing still, if you draw a trend channel on the 10-year Treasury yield, that nominal width is staying pretty wide. So I think that, that is one numerical contributor to that bimodal volatility situation where, yes, the central banks are more transparent. Everybody knows what's supposed to happen, but then it breaks loose. And when it breaks loose, you get big shifts. And when you get the big shifts, then you find out that there's a lot less liquidity relative to how much flow wants to move. And so I think that we're seeing a lot more micro flash crashes in the market than we used to see. And that is really a very big risk out there in the markets. And the only other thing I would add on that topic, though, is that over the years, on the tails side, that the equity tails have been, I think, uniformly fat on the left side, right? So you get, they're not normally distributed. You get bigger, negative shocks. But on the bond side, the volatility has gone up over the years. But in the government bonds, the skew, I think, has remained consistently on the positive side. And so there may be times when yields are just too low and you're not going to get that hedging or diversification benefit. But I think people thought yields were pretty low at the end of 2019, only to see government bond yields get a lot lower in a flight to quality environment in early 2020. So I think there is a secular bull market within that bimodal volatility distribution out there, and some interesting skewness properties out there across the markets.
Yeah, and I think that's a good result, at least potentially, for the folks that are using duration as some sort of, let's say, equity portfolio stabilizer. At least up at 180, you can make a stronger argument of a rally in the bond market during an equity risk off versus when the 10-year was yielding 120 or so.
I would say, though, although we did see that in the Bund as well, just moving much more negative. But yeah, I generally agree with you. It tends to work much better at medium or high yields than the very, very low yields. One
of the more fascinating prices I've ever stared at was the minus 80 nominal yield on the 10-year German bond. That was unbelievable. Well, Robert, this has been a great hour. I really appreciated spending it with you and getting your insights gained over a long period of looking at markets, and our audience is going to really enjoy this podcast. So thanks for being on.
All right. Well, thank you. Thanks for pulling me through.
You've been listening to the Alpha Exchange. If you've enjoyed the show, please do tell a friend. And before we leave, I wanted to invite you to drop us some feedback, as we aim to utilize these conversations to contribute to the investment community's understanding of risk. Your input is valuable and provides direction on where we should focus. Please email us at feedback@alphaexchangepodcast.com. Thanks again, and catch you next time.